Welcome to Nordic Small Caps. In this session, we will talk through OPTER's third quarter 2025 results and try to explain what has happened this year, why the share price has fallen, and what long-term investors should focus on going forward. The goal is to give a clear and balanced overview of the situation without getting lost in technical details. At the start of 2025, expectations were high. The share price traded around 125 SEK, and the company was valued at about 40 times earnings. This showed that investors believed OPTER would continue to grow strongly for many years. Today, things look quite different. The stock trades around 88 SEK, and the valuation has dropped to roughly 30 times earnings. Even though earnings per share are slightly lower than last year, most of the share price drop comes from the lower valuation multiple. In simple terms, the market is now willing to pay less for each krona of OPTER's earnings. Even with the weaker share price, OPTER's operations has remained solid. Revenue is up about 10%, annual recurring revenue is up by a similar amount, the number of customers continues to grow, and operating costs has increased only slightly. These are signs of a business that is still moving in the right direction. The one number that stands out this year is annual recurring revenue per account. This number has been almost flat, which is very different from earlier years when it grew around 10% per year. The lack of growth here explains most of the weak earnings per share performance this year. To understand why pricing has not increased, we need to think from the perspective of OPTER's management. Many of OPTER's customers operate in industries with low margins and strong competition. Bankruptcy risk is always present. The customer base is under pressure, and this is not new. It has looked like this for many years. A good example of this is the customer churn. In the last 12 months, OPTER added 109 new customers, but the total customer count increased by only 52. This means that 45 customers were lost. This does not mean that the product is bad, it simply shows how challenging the customer environment is. In such a situation, raising prices could push some customers to switch to another system, or in the worst case, cause more customers to go bankrupt. Losing customers is the most expensive problem for a software company. It is cheaper to keep a customer than to replace one. New customers need help getting started, they need support, and they sometimes need training. All of this increases operating costs. Because of that, it makes sense that OPTER has chosen not to increase prices in 2025. Management is likely protecting the customer base in a difficult year, even if it means earnings grow more slowly in the short term. This does not mean that OPTER lacks pricing power, it simply means that the timing is not right. Looking at the company's history supports this idea. Annual recurring revenue per account grew by about 10% each year from 2021 to 2024. This should be the growth in so-called normal years. Even in the difficult year of 2020, it still grew 4%. This year, 2025, annual recurring revenue per account will grow by only 0.5%. Some years are simply tough. In good years, OPTER has shown it can raise prices around 10%. With this in mind, it's useful to think about what 2026 could look like if conditions improve. Let's imagine a quite realistic scenario. I estimate that annual recurring revenue per account grows again by 10% due to untapped pricing power. The customer count will continue to rise to around 650 from today's 609. OPTER keeps an EBIT margin close to 25%, which is lower than the 2024 numbers, showing some conservatism. Revenue should increase between 12 to 15% from today's 100 million. This is due to higher pricing as well as more customers. In that situation, net income for 2026 could reach around 23 million SEK. This corresponds to an earnings per share of around 3.8 SEK. At 30 times earnings, this gives a share price of 114. The CAGR would be almost 30%. To sum up, 2025 has been a disappointing year for shareholders, mostly because the valuation multiple fell. Earnings were slightly weaker, but the business itself is still healthy. Customer growth continues, costs are well controlled, and pricing power is likely to return when the customer environment improves. The long-term drivers, more customers, higher annual recurring revenue per account, and stable operating costs are still in place. For long-term investors who look beyond one difficult year, OPTER still has the potential to deliver strong returns in the future, and today's valuation may give a good entry point. I have too been disappointed in the growth this year. However, I own the company due to its future growth potential as well as underlying economics. The ability to grow without retaining capital is very valuable and is why the company deserves a high multiple. Whether the market values OPTER at 30 times earnings or 40 times earnings is anyone's guess and depends on the belief in future growth. I believe the company will return to a growth of 15% in some quarters, making a high multiple warranted. Some value investors may think that 30 times earnings is way too overpriced for this company. Remember, however, that the earnings multiple is not only a component of growth, but also capital efficiency. At 30 times earnings, OPTER trades at a free cash flow and dividend yield of 3.3%. At this multiple, it only needs to grow 7% to reach the market return of 10% per annum. This valuation exercise doesn't work with 99% of public companies. However, OPTER is one of the few special companies. They grow without reinvestment, without retaining earnings. If you don't understand why this deserves a higher multiple, then you will never understand why some companies always seems too highly priced but still beats the market over time. This is not financial advice, and I do own shares of the company. Thanks for listening.